Most people think silver is boring, but today its market is flashing serious warning signs. Behind the scenes, supply, stress, and leverage are colliding faster than almost anyone expected recently. Silver prices on screens look calm, while the physical market tells a very different story. Several events happened simultaneously, forcing traders, investors, and banks to confront uncomfortable realities. About silver, China abruptly restricted silver exports, removing over 100 million ounces from global supply chains. That single move erased months of Western mint production without most headlines. Even noticing, initially, overnight Asian silver prices jumped far above American futures, revealing immediate physical scarcity conditions there. Premiums of $8 to $10 appeared, showing paper prices losing authority over real metal. At the same time, a major European bank faced a multi-million ounce delivery obligation. That obligation alone represents more than 10% of all deliverable silver available today globally. The futures market claims hundreds of millions of ounces backed by a tiny physical reserve. This structure works only when most traders never ask for the actual metal delivery form. Recently, that assumption started breaking, as demand for physical silver surged across multiple markets globally. American investors unknowingly provided another signal through unprecedented retail coin shortages nationwide this month alone. Dealers across the country reported complete sellouts of popular government-minted silver coins suddenly everywhere. When coins reappear, they carry premiums reaching $12 to $15 above quoted spot prices. That means real buyers pay far more than financial television. Silver prices suggest today publicly. This gap exposes two separate markets, one for promises and one for metal ownership direct. The paper market remains heavily leveraged with over 12 claims per ounce of actual silver. Such leverage would be unacceptable elsewhere, yet precious metals normalized it for decades, quietly unchallenged. Industrial demand quietly drains silver inventories through solar panels, vehicles, and electronics manufacturing worldwide growth. In 2024, industry consumed more than 500 million ounces globally. Total alone, investment demand added tens of millions more, while mine supply failed to keep pace steadily. The result was a documented structural deficit, pulling metal from existing stockpiles rather than production. Stockpiles can cushion shortages temporarily, but arithmetic eventually becomes unavoidable for any market system designed. One American bank spent years accumulating physical silver while prices stayed suppressed below fair value. That strategy quietly flipped the balance of power inside the global silver market structure today. Other banks continued selling paper, silver assuming supply would always appear cheaply during stress periods. Now those assumptions face reality as physical metal becomes scarce, precisely when delivery matters most. Lease rates for borrowing silver recently spiked, signaling extreme physical tightness within professional bullion markets. Owners prefer holding metal over earning interest, revealing expectations of higher prices ahead, soon likely. Hundreds of millions of ounces sit eligible yet intentionally withheld from delivery by their owners. The choice alone suggests confidence that future prices will be dramatically higher than current levels. As inventories shrink, behavior shifts and demand for physical delivery accelerates across institutions, industries globally. Futures holders suddenly refuse cash settlement, preferring metal security over currency risk exposure. Concerns rising. Industrial users secure supply aggressively to protect operations, dependent on silver conductivity properties. Daily critical. This feedback loop drains inventories faster than models predict under stressful market conditions today, globally. Once confidence cracks, prices jump violently, not gradually, because scarcity forces immediate repricing mechanisms everywhere. History shows commodity squeezes escalate until shorts capitulate or supply expands suddenly or intervention occurs. Silver today lacks rapid supply, relief making capitulation. The likely outcome for over-leveraged participants. Soon, paper prices therefore become unreliable indicators during periods of real scarcity and delivery stress events. Premiums, inventory reports, and availability now matter more than screen quotes for serious buyers. Today, investors ignoring these signals risk paying much higher prices later when panic sets in. Suddenly, those watching early can still act before shortages dominate headlines and mainstream coverage explodes globally. This is not hype, but mathematics. Playing out in real markets with finite resources today, promises cannot replace metal when delivery deadlines approach and contracts demand fulfillment legally binding terms. Silver's calm appearance hides mounting stress beneath the surface across supply chains. Globally, today, quietly, markets eventually price reality whether participants believe or not. Because scarcity enforces truth universally? Always. Understanding this dynamic gives investors an informational advantage during volatile periods of transition ahead. Now, ignoring it risks reacting emotionally when prices finally disconnect from paper anchors and spike hard. Silver has quietly shifted from sleepy asset to strategic battleground between institutions and physical supply. The next months will determine how violently this resolves as inventories approach critical thresholds. Fast, smart investors focus on signals before mainstream narratives change and prices fully adjust upward rapidly. Once shortages dominate headlines, opportunity usually has already passed for reasonable entry prices altogether. Then this silver story is still unfolding, but direction is increasingly clear to those watching closely. Physical ownership and availability are becoming more valuable than paper exposure during systemic stress cycles. Leverage magnifies gains until it magnifies risk catastrophically when delivery fails unexpectedly under pressure. Events. The silver market is approaching that inflection point quickly as inventories shrink daily worldwide. Now, prices will eventually reflect scarcity, not comfort narratives. Promoted during years of suppression and leverage, those prepared beforehand avoid emotional decisions during market shocks and protect capital more effectively. Long-term silver's fundamentals now matter more than opinions or forecasts from commentators unaware of physical constraints. Watching inventory depletion offers clearer insight than price charts during leveraged commodity market turning points. The calm before repricing is usually the quietest moment before volatility erupts across markets rapidly. Silver may soon remind markets why physical assets matter during financial stress periods, historically always. Those paying attention today will understand tomorrow's price action without panic or surprise reactions later. The silver market is no longer boring for informed observers, tracking supply stress signals closely. It is becoming a case study in leverage failure driven by physical constraints and demand. The next chapter depends on how participants react to shrinking inventories and delivery pressure. Now, markets reward preparation and punish complacency consistently, especially during structural transitions. Like this one, now, silver's transition is happening quietly, but accelerating fast, beneath surface price movements and headlines today. Ignoring quiet signals often leads to loud financial consequences when markets finally reprice scarcity brutally. Silver investors should watch availability, not just quotes on screens during this unusual period ahead. Physical shortages change behavior faster than analysts expect, especially when leverage unwinds suddenly globally. Now, the silver market's math is tightening day by day as inventory buffers erode worldwide quickly. Eventually, prices adjust to clear markets regardless of resistance from over-leveraged participants facing delivery realities. Those prepared mentally, financially, act decisively when moments arrive, instead of reacting late emotionally under. Silver's quiet squeeze is forming without dramatic headlines, yet visible to those tracking physical flows. By the time everyone notices, prices will already reflect scarcity and availability, premiums fully priced. Preparation now matters more than prediction in highly leveraged commodity markets facing supply stress today. Silver is teaching an old lesson about physical reality over financial engineering, and paper claims markets cannot ignore physics forever when materials become scarce and demand remains strong globally consistently. Silver's moment appears closer than many believe because inventory data shows tightening conditions, accelerating. Now this is not fear, but awareness based on observable supply constraints and delivery stress signals. Those who understand supply dynamics stay calmer during volatility and avoid panic-driven decisions. Later, silver remains a small market with outsized reactions when imbalances emerge between paper and physical. That imbalance is no longer theoretical as delivery stress manifests across institutions and retail markets. Understanding silver today means understanding leverage risk embedded within modern commodity market structures globally. Today, the coming months will reward attention and patience for those monitoring physical availability signals. Carefully, silver's story is far from finished as markets adjust to real supply limitations worldwide. Soon, subscribe for clear updates as this silver situation continues unfolding with data-driven insight and context.